For what it's worth, there's a lot of pressure from the administration for them to go bigger. My guess would be they would go 25 basis points. There's this, dual tensions between what's happening in the jobs market, which is soft, and getting more soft, which is one thing they monitor. But on the other side of the equation, they're also monitoring inflation, which has basically been sticky and has not continued to decline since they started cutting rates last year when they made 3 rate cuts. And I think they went too far last year, which is why we've seen inflation stay in this upper 2.7%, 2.8% kind of range where it's been here recently.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. With us today is a new guest, Todd Sheets. Todd, a fellow newsletter writer. You find him on YouTube at On Wealth and Progress, as well as his site, which is ToddSheetsWriter.com. Todd, it's great to have you on the show. So, hey, it's Monday, September 15th. The world is anxiously awaiting the upcoming Federal Reserve interest rate cut. And is it too little, too late? What's the game here?
Yeah, well, a couple of different perspectives, Kerry. I mean, first of all, I'm in the camp that, after 200 years of learning that central planning doesn't work, it does not make sense for us to continue to have, we can either a small body of people, of 12 people, or more practically one person deciding what the cost of short-term borrowing should be for a nation of 340 million people. We would be far better off if those short-term interest rates were set in the marketplace without government interference. But that's not the world we're in. So that raises the question, what are they going to do? What should they be doing? It seems pretty clear that they're going to cut at least 25 basis points. For what it's worth, my guess would 25 to 50 is kind of the range. For what it's worth, there's a lot of pressure from the administration for them to go bigger. My guess would be they would go 25 basis points. There's this, dual tensions between what's happening in the jobs market, which is soft, and getting more soft, which is one thing they monitor. But on the other side of the equation, they're also monitoring inflation, which has basically been sticky and has not continued to decline since they started cutting rates last year when they made 3 rate cuts. And I think they went too far last year, which is why we've seen inflation stay in this upper 2.7%, 2.8% kind of range where it's been here recently. My personal view on this, aside from not having a small group of people setting interest rates, is the bigger risks for the economy are on the inflationary side of things. If inflation gets back out of the bottle again, and the Fed is running monetary policies that are too weak, that is, I think, the most potentially disrupting thing that could happen to the agenda of the administration and to the economic recovery that we'd like to see. Then they've got to push rates back up meaningfully. And, we're going to look at issues in the marketplace with housing prices and all those kinds of things. So I'd err on the side of caution at this point in time. Like I said, I think they were too aggressive in easing last year before they really got the inflation rate back down to where it should be or lower, which is 2% or lower.
All right. So one of the ways that we kind of see the public's reaction is precious metals prices. And today we're hitting new highs yet again. Silver, which is the one that I'm following closer than gold right now, it's $42.38, up 29 cents. Gold is up $22.90 to $36.64, according to Kitco. So the market's kind of speaking now, isn't it?
Yeah, and I think the biggest fear out there has to be when we are running these chronic budget deficits of 6% or higher. The fear is that the Fed is going to monetize those deficits by holding rates too low and or also buying federal debt, and that is an inherently inflationary stance for the Fed to be in, and that's a very highly justified fear. I mean, this has been the problem for central banks going back centuries. If we go back to the 1700s, this was happening repeatedly in Europe. As one country would go to a war with another one, they would start to borrow money. The central bank, whether it was England or France or Germany or whomever, would print money to help monetize those debts. The currencies would devalue, and it got to the point where lenders were refusing to loan money to these European governments because this was a repeating cycle. And that's finally what drove Great Britain onto what became known as the classical gold standard. Isaac Newton was actually involved in that as master of the mint in the late 1700s. And the classical gold standard basically lasted throughout all of the 1800s and into the early 1900s. And it helped fuel the greatest economic boom in the history of the world. Better than anything before then and anything since then was this classical gold standard. And the U.S. was effectively on it for most of that period of time, other than during the Civil War. And, we benefited more than anybody else. So, in terms of the fear in the marketplace, I think the reason that you've seen longer term rate stays stubbornly high and you're seeing these issues with precious metals is because, everybody's worried that these chronic deficits are going to end up pushing the Fed to do the same thing central banks have done throughout history.
Yeah, it's like no matter what the problem, no matter what the perceived ill, the solution to the Fed is always the same: print money, right? Even when they're raising rates, they're still printing money, right?
Yes, I mean, in certain periods, yes. And this has been an especially difficult or egregious problem for the last 20 to 30 years. It played a big role in creating the housing bubble. And then after the bubble, when the great financial crisis came, they went back to the same playbook throughout the 2010s, which started pushing housing prices back up. It's pushed stock prices to PE multiples that are all-time highs, other than in a bubble, kind of in a non-bubble environment. We've seen higher PE multiples at the peak of a bubble, but other than that. And so it's been a very dangerous playbook for a long time here. And for a while, through the 2010s, they got away with it for a couple of different reasons, which have now, changed. One was all the offshoring to China and the low-wage labor over there. And going hand in hand with that and the great financial crisis, we had very high rates of unemployment that persisted and started coming down gradually later in the decade. But all those things weighed against inflation. And so, they kind of were able to get away with it without triggering consumer price inflation. But through this whole period of time, that money has to go somewhere. And it was going into housing, which is why we have a huge affordability crisis right now, because housing prices went up so much faster than incomes were going up, which was not the historical norm in the past. And then we've had this run up in stock prices and in these precious metals and that kind of thing. So yeah, this has been a recurring problem throughout history and an especially big problem over the last 20 plus years.
Could not agree with you more here. And so what's the solution? Abolish the Fed?
Yeah, well, yeah, I think that would be the solution, is abolish the Fed, get back to a situation where we have short-term interest rates being set in the marketplace, like most other prices in the system. And that is the place where you have millions and millions of daily transactions taking place between borrowers and lenders. And all of those transactions are determining where short-term rates should be, what lenders are willing to lend at, given their concerns about inflation, what borrowers are willing to borrow at based on what makes sense for their business. And instead of letting the marketplace discover the right interest rate, like we ideally do with most other prices in the system, we've got this intervention where the Fed is trying to either pump up or restrain or hold the perfect rate. It just makes no sense. I mean, and it hasn't worked. If we had gone down this path and we had, 60, 70 years of great results, that'd be one thing, but we don't. We have 60, 70 years of runaway inflation in the 1970s, which they finally got under control in the late 1980s. They started working on it in the early 80s. It finally got things back down in line in the late 80s. Things were relatively good for about a 10-year period of time there. But then they went back to the same playbook, and, that gave us the housing bubble, and then it gave us the affordability crisis. So
true. Spoken like a true Austrian economist there, Todd.
Yeah, I'm a big fan of those guys, actually.
We put our friends over at Mises.org and Tom DiLorenzo, good friends of the show here, and really stand-up people. They're also being suppressed by a certain digital platform who will go nameless, but suffice it to say, you are watching this or listening to this video on that very platform now, so that should tell you everything you need to know. Hey, so we're not really going to see any of this take place until there's an out-and-out disaster, are we?
Yeah, the sad thing is we've had disasters. I mean, the housing bubble was an enormous disaster, and, the inflation of the 1970s, but unfortunately, it's like this, the Fed's role as this interventionist and this entity trying to manipulate the economy evolved so slowly. And it basically evolved out of their failure during the Great Depression. The Fed was originally formed, like we were talking about earlier, in the early 1910s with the purpose of providing liquidity to the system to help avoid isolated bank failures from turning into panics. And that was their objective and their primary purpose. And we got to the Great Depression, and they failed to fulfill that mission. This was Milton Friedman and Anna Schwartz.
That's true, yeah.
Which showed that the Fed's failure to do the job it had been created for was what turned the Great Depression into probably the worst downturn in the history of the country. So, in part because of the Fed's failure, FDR comes in, and with the brain trust, they start experimenting with these massive interventions, one of which was to do the job intended to do the job that the Fed had failed, which was deposit insurance. So they said, okay, well, we're going to put deposit insurance on everything. And that effectively worked. I mean, to some extent. I mean, the truth of the matter is, by all measures, the number of bank turns were probably at their nadir in early 1933 and had probably already bottomed out at that point in time. And so it was probably over anyway, but they put this deposit insurance in. Well, that effectively negated the role that the Fed had been created for, because deposit insurance, that was going to stop runs. People had confidence now. It was a bigger blanket. So the Fed had to reinvent itself effectively after that, which it did. And it reinvented itself. I think the key point was when William Mackenzie Martin defined the Fed's job as taking the punch bowl away before the party overheats. And this was in the 1950s. And it was like the idea was, well, if the economy starts overheating, we'll prevent us from going into another depression, because we'll start raising interest rates and we'll monitor this. Well, they then create the opposite problem when LBJ's spending, the guns and butter spending of the 1960s starts to click up in the late 60s, and we start running chronic deficits. What happens? The Fed prints the money to monetize those deficits, and that pushes us into the inflationary 1970s. And so then later in the decade, we get this new Federal Reserve Act, which gives them the mandate of controlling both watching inflation and watching unemployment. And so it's like this evolved so gradually under the surface over time that everybody just accepts the fact that we have them playing this enormous role in manipulating the economy, in spite of, the inherent theoretical fallacies of the idea to begin with. And then on top of that, this long track record of disastrous results that has come from this institution. So
I couldn't agree with you more. Couldn't have said it better myself. It's so true that that this experiment, it's going to come to a bad end. One of the other things that the Federal Reserve took on since the great financial collapse was basically that they're not going to let the stock market go down either. And they've been very effective at that. So I guess if you're holding a lot of stocks, a lot of assets, you're a beneficiary of asset inflation, you think the Fed's doing a great job, but when you go to buy groceries or buy a house, you don't think so much. Todd, it's great having you on. You find him at toddsheetswriter.com. Links in the show notes to this interview on financialsurvivalnetwork.com. We've now switched totally to Substack. I'll be sending out a little message explaining the decision to give up the traditional website. Todd, really appreciate you coming on. We'll talk to you again soon.
Delightful to be with you. Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.